What's up, YouTube? It's Joe Cacciapaglia sitting on the couch making some money investing in fractional real estate online. As usual, today we have a new Padsplit in Glendale, Arizona, listed on Mogul.Club. This is what they call their VIP launch, so it's not on the site yet, but if you need the link, it's in our Discord. It's also in the 400 Club. That's where I found it today. This is it's two homes on one lot. The lot appears to be zoned C3 commercial from the Glendale website that I found, the zoning website. Each unit is 3 bedrooms, 2 baths. They're going to add an additional bedroom to each. So it'll be 4 bedrooms, 2 baths in each unit. It's not operating as a Padsplit yet, so this is very different from what we've seen from Mogul so far. There's a lot of stuff that I like about it. There's a few things that I don't, so we're going to jump into the due diligence. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online, Mogul being one of them. Some of those links will give you some free money with your first investment. Do your own due diligence on that, because some of them say they do and they don't actually do it. And also any of the, also just do your own due diligence on those platforms, on any of the properties you hear me talk about. Just because I'm investing in them doesn't mean it's the right move for you. And also in the description of this video, there are links. There's a link to the Discord that I have set up. There's a whole bunch of us that talk about all the different fractional real estate platforms, what we're investing in, that sort of thing. Feel free to join there if you haven't already. But let's get back into this. Okay, so what is different about this deal from a lot of the others is Mogul has typically been buying in-place income. They're typically buying operating Padsplit or operating short-term rental. They're making projections based on that income, and so we're not having to guess very much. Here, they're actually asking the seller to convert it to a Padsplit, to list it on Padsplit, to furnish it, and to add the additional bedrooms. Now, they say that in this email and in the listing. I can't find anything about that in the contract itself, so I thought that was a little bit odd. I did take a quick run through the contract. I could be missing it for sure. The other thing, I forgot to actually look if they have the appraisal contingency, which they usually do. I'm just not as familiar with this contract, but yeah, it looks like they have that in here as well. That's one of their typical things, but I just thought about it because I mentioned, usually it's one of the things I'm looking for in the contract. Obviously, if you're going to invest in this, you want to actually read that whole contract, see what they are and aren't agreeing to. I am very curious where the agreement, if it's an amendment that we just don't have access to, if there was an addendum that we don't have access to. But they say that the seller is furnishing it, listing it on Padsplit prior to closing, and also, creating the 2 additional bedrooms. So far, Mogul hasn't given me any reason not to trust them when they say stuff like that. And so my guess is we just don't have that paperwork, but, it's up to you if you want to, make that assumption, or, reach out to them. They do answer questions very quickly if you use their little, the little question link that's usually hanging out down here. I don't know why it's not on here on this one. Is it on this one? Anyway, there's usually a little thing down here on one of their web pages, and you can reach out to them, and they're pretty quick to respond. This one does have, we're starting to see more and more this lower, 12% average yield, 12% IRR. They're calling this a core plus. I guess even though the seller is, this is like, okay, there's some renovation being done. It's a new business model, but at the same time, we're asking the seller to do that before we close. So is it core plus? Is it value add? I think it sort of skirts those two, right? As long as that work is done, the bedrooms are the furnishings are in place, and they've started to get it rented up, I can kind of see the core plus aspect, because you're not doing the full business plan change. But lower projected returns than we've seen on a lot of their stuff, but kind of in line with what we've seen on some of their more recent deals. If you look, their year one yield that they're predicting is 8.3%. One of the things that I would guess is because they tend to be pretty conservative on the income side of these in general, and so my guess is that they're being even more so because because it's not actually operating, so they don't have any in-place numbers to look at. Now, whether or not that's true, I don't know. They're saying 75% loan to value. This is one of the things somebody mentioned in the Discord, that, well, here we say, okay, we're going to use a 20% down loan. Here it says 75, where's that discrepancy? One of the things, and I'm not sure this is how the contracts work in Arizona, but if there were were in Texas, the way our contract works, and every place where I've ever worked, I'm assuming, we're saying as long as we can get a loan that's at least this good, we are obligated to close, right? That's what our contingency is based on. If we have a financing contingency, so when we outline the financing, we're saying as long as we get at least as good as that financing. And so so 75% is worse than this, right? So we're basically getting a contingency at a higher LTV than what they're underwriting the deal as. So I feel good about that. I think that's not actually a problem, that those numbers are different. If it were the other way, right? If our contract said we have to do it at 25% down, but we only we underwrote it at 80, then there could be a situation where, okay, we qualify for a 25% down loan, but the numbers don't work as well. If it, like I said, if it was flip flop. So, but the way it is, I think it's perfectly fine. I'm happy with that. So they're underwriting year one rents of $70,000. I wanted to, let's see. Oh, where did it? So I looked at Padsplit and I put the address in. I put 2 bedrooms with en-suites, 6 bedrooms without. They say the gross potential revenue is here, and so effective gross income is $65,000. So just not tweaking anything, just playing with Padsplit's calculator exactly as is. Their top line revenue, and it ends up being a little bit higher, right? Because when they're giving us these numbers, they're saying 70. I believe that should match up with this effective gross, because they're building in, you see there's not another vacancy line item. This property management isn't including the Padsplit fee. So this should be net of all the Padsplit, I believe. So they're projecting something a little bit higher. I don't know where that's coming from. To be perfectly frank, I haven't used Padsplit's own calculator a whole bunch. And so, and this is all that I did, right? I didn't change any of the settings or anything. So there could be some other assumptions that they're making. They might have looked at the comps. I'm really not sure. I've really come to just trust them on that, on this side of things. On the yield side, I've very rarely passed up one of their deals because I think that they're being too aggressive on their yield or anything like that. It's almost always, if I don't buy something that they're doing, it's on the valuation side. This is one where, okay, it looks like they're shooting a little high with this number, but again, I'm not so confident in this Padsplit tool that I think that that's right. And then, everything else seemed to make sense to me. And so, gets you to the 7.6% unlevered cash, 8.3% cash on cash the first year. And so that's assuming it stabilizes very quickly as well, right? To get to there in the first year. One of the things I always like to do is shut off the refinance and see how that's going to affect our returns. Okay, brings us down to 11 and 11. So that assumption looks like it's helping us about 1%, right? And what are they assuming here? That sometime in the next 5 years, we're going to be able to refinance another loan. Yeah, another interest-only loan at 5% interest. The way the interest rates are heading, I think that's a reasonable assumption. I also believe they're probably getting a rate lower than this based on their most recent webinar that they did. They mentioned that, future loans, even though they're underwriting at this 6.75, that they were already getting quotes lower than that. So, like I said, I mean, their yield portion, they typically seem to be pretty conservative. And even though I'm not matching up exactly, I'm perfectly happy with it. And, one of the things that you can do, is this where we can edit it? I don't remember where we actually edit it. No, one of these fields we get to edit. We can actually go in and change the rental amount. Oh, it's here. Yeah, so, okay. I'm just going to do 65,000 divided by 12. Okay, 5,400, right? So if I change this to 5,400, oh, I think this is the one I can, yeah. How's that? Okay, yeah, that gets me that 64.8. Okay, brings down our average yield to 9.9. What is our yield year one with that? We can look here, and our year one would be 6.5%. Okay, so that is pretty low, right? So if that ended up being the real number, it's not great, but at the same time, if you look, if you look at a lot of the other deals that we're doing, not that we're doing, but if you look at a lot of the other deals out there, like it would be a very high yielding deal on arrived homes, something like that. I'm not super excited about, the 6.5. So, but again, like I said, I'm going to trust that they've put some work into this number, and they, more so than I have. And because I'm close enough to where, what they were, I'm at 65 versus 70. And I mean, obviously it does make a big difference, right? I mean, as you start to, and this is, again, I'm not exactly right here, but what does that do? Yeah, that gets us to the 11.5, and the year one is 8.1. I mean, the pad splits in general have been great yielders. This is not matching up with, what we're seeing for a lot of them. But again, I mean, I believe that they are trying to, give us some conservative numbers, and, I also believe they're using something more than just this tool to come up with that. Obviously, I could be completely wrong. My faith could be misplaced. So you're going to have to decide, like, oh, let me close that. That was the Discord I have set up. I try not to usually show that, but I think it's not a big deal. Brad was actually helping out, and I was going to talk about this with some due diligence. That's why you should join that, right? There's always some good due diligence stuff. I'm going to jump into that in a minute, though. Let's see. Let's first. Oh, yeah. So it is in Glendale, Arizona. I talked about this market quite a bit, or in the video, this for the Swift. So if you want to watch just my comments on the Glendale market in general, why I like it, you can just search in my channel for the Swift, and you'll find just the first probably 5 or 10 minutes of that video is talking about Glendale and what I do and don't like about it. I spent a little time. This is, like I mentioned. Oh yeah, this is it's zoned commercial, and it's zoned C3 commercial. You can see there are some other single family homes in this zone. There's some, other residential dwellings. This thing's in the way. When you do the little street view, it doesn't seem like the nicest residential area, but this is, it is still kind of in line with a lot of what we see, for the pad splits, right? It is typically the cheapest housing in a given market, because you're renting a room. And so I'm okay with this. Oh, I just froze that. Let me just close it. Yep, not responding, but still recording. I love it when that happens. Okay, so I'll close that map. I think I want to talk about the zoning a little bit from a couple of perspectives. One, I think it actually is a good thing from I'm always worried about, okay, is pad split, is that going to get, are there going to be rule changes that make it so you can't operate a pad split in a residential home? And I think that's always possible. One, I think because we have two homes here, not just one, we have a better chance of being okay with the multiple rentals. But in addition to that, I think being in a commercial zone, you're much less likely, maybe you're going to have to go get a hotel permit, or if the area has a boarding house permit or something like that, get one of those. But a room rental on a relatively short-term basis does seem to match up with a commercial use. Now, I'm not versed in Glendale zoning whatsoever, so I don't know that that's actually going to be the case. Let's see, I did look at this, my home's in a commercial zone. Can I expand my dwelling? And they say no, right? So, I mean, that's one of the things. This is just on the Glendale, Arizona FAQs from Planning and Zoning. So apparently they do have a lot of these homes. So I don't know. I think it could be good and bad. And I also think for the future, it's very possible that the highest and best use of this property is going to be as some commercial use, as, depending on how the city builds out. And I'm going to have to search and look at that map again, because I want to show you there's some things going on here that I think are actually really good for this being a pad split. And we haven't had another one that I can think of that this was the case. So, one of the things we're always talking about is, okay, how close are we to transit? Okay, so we've got a bus stop here. I think that's actually the closest one. Let me zoom in and see. So that's not so far, but it's not the closest. It's not super close. But one of the things that we have here that we haven't had a lot, and that when I've talked to the pad split people in the past, they really like, there's a lot of places that it could be potential employers that you can walk to, right? So you've got all this automotive stuff, a body shop. You've got a lot of different restaurants. You've got some different offices. All this commercial stuff that's within walking distance. Depending on how you define that, but within a reasonable, commute by something other than car, which I think is very important. We're always talking about, okay, do we have enough parking and whatnot? That is one thing that I'm not sure about here, right? We do have, it's tough to see like how the actual parking is set up. You have, you can't see it from here. Wait, am I facing the wrong way? Or is this just further? Image capture 2022. What is going on there? Am I facing the wrong? Oh, I'm facing the wrong direction. Okay, sorry about that. Yeah, it doesn't seem like there's you've got some street parking. There's not, this isn't like it's not a dense residential area, so maybe. But yeah, I'm a little bit concerned about the amount of parking that exists here, except for, you are close to the bus, and you are walking distance to a whole bunch of stuff. So I think it's possible that somebody who's renting a room here is just not relying on a car whatsoever. And, there is a little bit of parking both in the front and in that back where we had that alley. The potential for some parking there anyway. I think, can I do the street view back here? No, see, I can't drop it back there. So I'm not really sure, but I think there's oh, what happened there? I think there's the potential to park behind as well. We're back over here, right? Anyway, I'm going to stop with the street view. So that's one of the things I think is a big plus here that we haven't seen in many of the other places. Obviously, you should spend some time, open up each one of these pictures, really look. It does look like it's a nice renovation. And so if the people doing this renovation are also the ones making the extra bedroom for us, I think that's a good thing, right? Like they're already, we know they're doing relatively good work. Or at least it appears to be so, right? And of course, the Mogul guys. Have I been calling them the Padsplit guys when I should be calling them the Mogul guys? I might have been. I don't know. But anyway, the Mogul guys, I've come to trust their, their how they deal with inspections, and we've seen them back out of some deals now, and then we've seen them negotiate some really good concessions and additional work. So, I don't know. I think that should work out well. I'm at least optimistic about that, right? And again, you want to make your own decision on that. But one of the things I noticed, Zillow does say that the 1 year change, property values have gone down 4.6%, and Zillow thinks it's going to go down a little bit further. This is one of the most drastic, peaks and valleys we've seen, although this shape is very familiar, and we've got this little, this little hump after the big one. And again, what happens from this point forward is going to be very much dependent on the economy and on interest rates. We've seen this over and over again. But Zillow thinks a little bit more on the downside. Take that for what you will. I think in the long run, Glendale is a market I want to be in. It is, they have good population growth, which is one of the things that I look for the most when I'm looking at residential properties. All right, let's see. FEMA. So this is, the whole area is in the shaded X flood zone. And we saw this with the Swift as well. Oh, wait a minute. Oh, yeah, this is the AO. I was like, wait, are we in AO? That was going to freak me out. But no, that's this here. So this, I believe, is all going to be the shaded X, which is, I'd rather be in an unshaded X. But I've talked about this a whole bunch in the past. I talked about it probably quite a bit more in the Hugo video is where I first ran into this, but then definitely in the Swift video as well. So I don't want to beat it up too much, but it is, a little bit higher flood risk. As I've mentioned many times, I think the Mogul guys, they seem to be well versed in, properly insuring for flood risk, and all their other hazards. And so that, this is one of the things where if I were buying this myself, maybe this wouldn't be a market that I'd be in, but where I'm not the one who has to deal with the flood claim if it happens. And, people that I think know what they're doing are on top of that. I'm okay with this. And so I've bought a few now that have been in this zone as fractions, right? But I haven't ever done it for whole properties for myself. So, because I think we get some other benefits from fractional real estate, if you've noticed as time has gone on, I have taken a little bit more risk with some of these deals than when I'm buying whole properties on my own. But I think I'm also reducing my risk some, by getting just very wide, both geographic diversification and then just diversification of having multiple properties. So if something goes wrong, it's only just a little bit of money on each one. Let's see. The crime map, this kind of scared me at first. I saw, quite a few gunshots. This is only a few days. But it is, if you realize, okay, well, wait a minute, it's a pretty big space. If we zoom into the neighborhood, there was nothing in right here. But also when I clicked on each of these, they were shots fired, reports, but it didn't actually say. One of them said shots fired, and then, it was a call. It was reported, but nothing came of it. One of them said they did find spent casings, but none of them were like a person got shot and there was a report of that. And then, so it made it look a lot worse than maybe it really is. Although, somebody shooting a gun inside the city limits, not great. Yeah, but so this is not a great crime map, but this is only a few days, and which is why I've started using this neighborhood scout as well. And we are right in this zone right here. I think heart of Glendale / Sugar. It looks like this is right where we are. And so you can see it's shaded as one of the most dangerous parts of town. We have just seen this quite a bit with the pad splits, right? That's where we're finding them. I don't love it. But I understand that that's probably going to be where where a lot of them are going to end up, right? If you just think about, like, if we're providing some of the lowest income housing in an area, often it's going to be in parts of town that are, have some of the higher crime or have obviously some of the lower incomes, and a lot of times those two things, tend to get grouped together geographically. So, I don't know. I haven't let this stop me from buying things yet, having the higher crime rates. I really, when I look at this, it's definitely something that will keep me from buying a short-term rental, because I think that your reviews for your properties, if guests feel unsafe, Like it can get really, I think early on you saw me pass up some of the Houston short-term rentals that Mogul had because I just thought you'd end up having, guest reviews that complained about the area. I don't have that same reservation with the Mogul, with the pad splits, but I don't know. I mean, obviously, I'd much prefer to be in a lower crime area. I don't want to be in the most dangerous part of town, but that's just where we end up. Let's see. That's just the zoning map and the FAQ. Let's talk a little bit about the valuation. So, Zillow, Realtor, and Redfin, none of them are giving us an estimate of value because it's pending, or and there's one of these had like a little note that said we're not giving you the estimate because like the agent opted out of it and it's listed or something. So we've seen this in some markets where you can't get that. It is, there's a couple of things going on that makes me a little bit less worried about the valuation here. One is we are 2 homes on a commercial lot. This is going to be something that Zillow or Realtor or Redfin are going to be horrible at valuing, right? There's not an easy apples to apples comparison to just compare a 6-bedroom, 4-bathroom home, right? I mean, that's not really what we have, but they have it listed as a single family residence. So what I did is, so Brad actually started this and he shared a couple of things. So this is a home that's relatively close by that we do have his estimate for. And this is one single family home. It's $324,000. And we have 2 homes. Now I wouldn't expect that you can just double it though, right? Just because we have 2 and this is 1. Because it is still just on 1 lot. And so it's not necessarily going to be twice as valuable in my mind. He also pointed out this lot, which is just down the street. This is like 3 houses down. It's a vacant lot that sold for $205. I already closed the map, but you can just see this is like people are just storing stuff in that space, or they were. So maybe this was purchased. It was purchased earlier this year. Maybe this was purchased for some commercial construction. Maybe it's just going to continue to be used for storage. But okay, you've got a vacant lot, so just the land value. Let's see. I believe this is relatively similar sized lot. Let's see. Yeah, 7,000 square foot lot. And this was, less. Yeah, this is a slightly smaller lot. Just the land, 200. Okay, and then what I did is I also looked up some duplexes. This was the cheapest duplex I found. For 55, so this is a full 100,000 cheaper. It doesn't have beds and baths. It doesn't have square footage. I couldn't find that info on this one, which makes it tough, right? Yeah, and it says 2 buildings, 2 units. So I'm not really sure. What was if the second unit? I think it's this. Oh, let me get back to it. I think it's this. I think it's an above garage unit, but I'm not positive about it. But it doesn't appear to be 2 full homes. I found this other one this one was. Let's see. This one it's a much bigger lot. But you can see it appears to be 2 full homes on a much bigger lot. Similar beds and baths. I think they have 8 bedrooms is what we're going to have, but the 5 bathrooms, but a lot more square footage, right? This is much bigger, but also priced way above it. And so that's one of the things. It's going to be super tough to get a good price on something like this. It's 2 homes on 1 lot. There's just not a whole bunch of them, and that's kind of what I just want to point out. But all I'm doing is looking at some things to give me sort of a feel for it, right? This one is a single family home. The home itself seems like it's about the size of one of the homes, but then there are 2 1-bedroom, 1-bath units that come with it. And so this is really 3 units, but 2 of them are just 1-bedroom, 1-bath. How does that measure up? it seems right to me that it's around, a tiny bit more than what we're purchasing. And so what is our purchase price here? $548,000, right? And remember, this price comes with the bedroom conversion and fully furnishing it. So I think that's pretty good, right? I think that this is one where I feel good about the pricing. Now, I also, like I mentioned before, I always like to, when I can buy a residential property where the numbers make sense and it allows me to hold something that's actually a commercial property, for, basically land banking. Like some point in the future, maybe the highest and best use becomes to redevelop it as commercial. And oftentimes when you can do that, it's going to be worth more money with that use. It's also possible that we could, changing it to a multifamily zoning would technically, I don't know. Again, I'm not familiar with Glendale zoning, but in most places where I've worked, changing from commercial to multifamily would be considered a down zoning, which is usually easier than an up zoning, right? And so changing it to a denser multifamily, I think there's potential for that. Oh yeah, look at this. When I was talking about the parking before, there is, I think all of this is parking. I don't think this is long. I think this is, you're going to be able to drive on all that. Even though this is a driveway, maybe not. Let's see if we can open that in its own thing. I know I'm all over the place today. Sorry about that. You're used to it by now, I know. Let's see. Yeah, see, that's the gate where you can drive in from the back. So it does look like maybe they're just going to be able to park all through here, which is fantastic, right? So I think the parking issue is maybe a non-issue. Okay, let's go back to, what I was talking about. Like, I like the idea of being able to land bank, to be able to hold on to something that maybe we could use sell as commercial sometime in the future. As somebody could, buy it thinking they're going to build more dense multifamily. Doesn't mean that there's necessarily any upside there. You'd have to do a lot of work to really figure out, am I getting, is there some opportunity? But there's that optionality, right? And so I always like it when I have that ability. I've done that in the past here in town, looked for properties where, again, it's a single family residence, but it's zoned commercial, or it's zoned a denser multifamily. It just gives you, the potential for some more upside than what we necessarily have just on the future. I didn't even go through their two comps this time. Would probably be useful to do so, although that's kind of interesting. They have one that's way smaller and one that's twice the size. I don't know what they're doing there. Obviously, if this is something you're going to invest in, definitely check out their comps as well, right? Pull those up on, pull those addresses up on Zillow or whatnot. But just based on, the work some of the work that Brad shared and the stuff that I did on my own, I feel pretty good about this value. Like, I feel like, and it had been listed for a while. They started it at $599, I believe. They dropped the price, and then we have it under contract for another $12,000 lower than that, plus the additional concessions that we talked about, right? Show more. Yeah, there's been a lot of price changes. So, I think this is, I'm very happy with it from the valuation side. And again, because it's such a difficult property to value, because it is two homes on one commercial lot, I think we're not going to get there. So, okay, in summary, what do we think about this property? I like that it's two separate homes, right? So we're only actually renting 4 rooms per home, and it's 4 bedrooms, 2 bathrooms per home. I like that, the parking setup seems good. I like Glendale in general. We are close to, we're walking distance to a lot of the types of employers that I think our Padsplit guests or members would be working at. The crime map is not great. I'd like to be in a much better area than it is, but it's, I've sort of come to expect that, although we have seen some pad splits in nicer parts of town. So, or, parts where there's been lower crime. I feel, like I said, I feel good about the valuation. I'm a little bit worried about, this is the first time we're not buying in-place income. So we're having to trust that the guys at Mogul really understand what that income is going to look like, right? And if they're wrong, we could have a real problem. We could have, we could have income that doesn't match up at all. When I was looking at, okay, the Padsplit projections, just using Padsplit's website, it looked like maybe Mogul was estimating about $5,000 high just on the surface, right? And whether or not that's true, I don't know. And you have to figure out, is that something, do you trust what they're doing? Do you think they're, and so far, my portfolio has performed very close from, to how they've predicted on the Padsplit side, or better, actually. A lot of them have done better. But on the short-term rental side, I've definitely had some misses. So, they're certainly not perfect. And, whenever we're trying to predict the future, you're not always going to get it. So am I going to buy this one? Well, let me think. I'd like to have another property in Glendale. It is in the Shaded X flood zone. I already mentioned that, which I don't love. But if that were the only issue, I think I'd still move forward. The biggest issues for me are, one, it's the first one from them that's not in place income, and the crime, and then even if we just trust their numbers, it is a lower returns than what we've come to expect from them on a lot of their stuff. And is it really core plus? Yeah, I think we went over that, and it is. So I don't know. It's tough. I've got money just sitting on Mogul right now because they refunded one of the other deals that canceled. But I still am just trying to be really picky with them, right? And I don't think I'm going to pick this one up. I'd like to see how well they do at predicting, because like I said, this is the first one we're seeing them having to just come up with their projections, without having any in-place income. And I just would like to see how that goes before I invest with one where they do that, especially because the one third-party source that I have, the Padsplit website, makes it look like they're being a little bit aggressive. Let me refresh this because I think I messed with that rental income and it's not showing what theirs actually is. Yeah, this is what they had, 70.188. Let me see. Yeah, so that's I think, wow, a whole bunch of this is sold out now. 152,000. How much are they raising? 267. So not a whole lot of time to waffle and decide whether or not to jump in. Man, I hate to pass on another one. I guess maybe just this lower projected returns is what we're going to start seeing from them. I really like the valuation side, though. I think that it seems to me that this is, they've got a good deal on that side. Now, one of the things that I was thinking about, too, is because this is a new business model for this property, what would this look like just as 2 long-term rentals? And it didn't look great from there, right? Like, if you just looked at what rents were, I couldn't really... Oh, can you just click this and will it pull in some projections? Yeah, look at that. That's interesting. Now, obviously, you'd have to do some work and figure out, okay, is this rental rate right and everything like that? Monthly rent. Maybe this is right. Maybe each one would be at $1,300 or 12 or 13. I don't know. Obviously, you'd have to do some work on that. But just when I was looking at it, it seemed like it wasn't going to work well. I haven't been doing that for most of their properties because they've had the in-play, the business model already in place, already making money, being able to show, hey, we're doing this. So, it's super tough because normally I'm saying, okay, we have this in-place income, but I don't like that we're paying too much for it. Here, it doesn't feel like we're paying too much for this property to me, and again, I mean, this is a feel thing because you're not getting an apples to apples comparison. You have to just look at what else, the other data points out there. And obviously we're also going to get an appraisal. So this is, this is the opposite situation. And so maybe I just am being too greedy where I want to feel good about the valuation and I want to be buying in place income. So there's no guesswork. And maybe in this part of the cycle, that's not going to be possible. I don't know. Again, the crime map, just not in place income. I think for now, I'm probably going to pass on it. One of the things too is where the secondary market should pop up next year. I'm really interested to see, okay, what are we going to do there? So I have been more hesitant, and I'm just waiting for, the very best deals to pull the trigger on in here. Anyway, that's what I'm doing. Let me know what you think. Are you going to buy some of this? If so, let me know why. And if not, share that as well. And until next time, please like and subscribe. Do the thing with the bell. And until next time, I'm going to keep making mistakes so that you don't have to.